What's up, guys? Welcome back to another week of talking everything real estate and mortgage. And I hate to be those guys, but we have to kind of talk a little bit about what happened, major event that happened in the economy, which is the collapse of Silicon Valley Bank.
March Madness in the financial sector
Yes.
is, I think, what's happening. So we have three banks now, right,
Yes.
that have essentially collapsed with pressures due to a number of things,
Yes.
right? And so break down a little bit about maybe how, why this occurred.
Yeah, so essentially what happened is that we're running into an issue right now where you can make a larger return on a 2-year yield than you can leaving your money into a bank. And kind of the way that Silicon Valley Bank grew so quickly is because they are a product of venture capitalists and startup companies out of the Bay Area. And now that raising money is a little bit more expensive than it was back in 2019, 2020, 2021, these startups and these venture capitalists now need to figure out a way to make a better return on all of that capital. So they tried to essentially withdraw all of their money quickly, and Silicon Valley Bank was unable to provide those funds.
So about 90%, right, of money that's in a bank isn't actually liquid.
Yes,
and most
exactly.
people don't really know that. So if there's a large run on withdrawals in a short period of time, banks just don't have that money to give to people. And so they tried to go borrow it, couldn't do it. The other thing we're not really touching on a lot is there was some mismanagement.
Yes.
When you peel back some layers on this, they were without a chief risk officer for a number of months, which is a clear violation. We saw some of the executives doing large stock sales. Again, maybe some unethical things that may have transpired. Nonetheless, I know we both don't think that this is the collapse of the U.S. banking industry or anything like that. I would say that this is more of cause and effect of some of the Fed's aggressive measures of hiking the Fed funds rate and the cost of yields kind of disproportionate to where they should be, right? And really shaking things up. Now, how does this impact long-term mortgage interest rates?
Well, I would say how it has affected long-term interest rates this week specifically is it really just is a clear situation that these rate hikes are actually working, right? And if you've I know you've watched our videos in the past. There's a lot of data that is released that has kind of lagging indicators, and for one reason or another, the Fed hasn't caught on to that yet, and they're just looking at today rather than looking at that lagging data.
What I find really suspicious, right, is that the Fed says they make all their decisions based on data. But I also think the Fed doesn't understand the data that they're making their decisions off of. And to your point, if they would just be a little patient, they would see that the action they've already taken has already taken effect and started to work. And what I think this banking collapse is going to be a clear indicator that they're going to have to now address it. I do think there will be some additional Fed rate hikes, but I think it's going to cool off, and it's going to cool off pretty quickly now based on this info. And what we will see is interest rates based on the economy going from inflationary to deflationary now, right? Like we've talked about, will cause interest rates to start to come down. We've already started to see some signs of that. There's just really been, I think, more from investors, secondary market investors, more just indecision, trepidation still. But I think when dust starts to settle, right, and data starts to get uncovered more, we will see more strength in our theory, right, of deflationary economy and lower interest rates. Lower interest rates should increase buyer demand. I want to pull up this chart, Jack, because I find it fascinating. We hear so often, right, that home prices have gone up so fast, that means that home prices are going to go down.
Yeah.
Because what goes up has to come down, right?
Well, we're in the same situation as 08, 09, right?
Right or wrong, right? So let's look at this. This goes all the way back to 1942. Mm-hmm. And just look at the record here. Over 81 years, you had 73 of 81 where home prices actually increased. I don't know about you, but I would take that.
Yes.
That
would be a championship record.
That's a great record to have. Now, let's dig a little deeper. From 07 to 2011 is 5 of that negative, of those -7 years that we had. Mm-hmm. We know what happened during that time. It was breathe here, fog up this mirror, get a mortgage.
Yes.
Right? We know that that's not the case today. Mm-hmm. Far different, right, in obtaining a mortgage right now. So if we isolate that out, then let's look back at the other negative years. Mm-hmm. 1990 and 1991, 1% loss.
Yes.
Again, that's still negative, yes, but look at the amount of appreciation prior and just over the course of time. Look at the history that says double-digit appreciation does not equal immediate losses. And that's what we kind of have to push back on. All of this belief and theory out there saying, hey, home prices are going to go down because they have to go down is inaccurate. Even if we look back again, not only to the mortgage crisis, but the amount of inventory in the market from 07 to 2011, and it's drastically different than we have today.
Yep, it really just boils down to simple supply and demand economics formula. So without an increase in the supply and a massive decrease in the demand, then the value is going to stay.
We had one more bit of good news this week, which is the FHFA announced that they are pushing out their loan level price adjustment for debt to income ratio. Jack, tell us about it.
Yeah, so that was causing a lot of drama in our world just because people's debt to income ratio, especially when someone is self-employed, changes so often and so quickly throughout the process, and it's a quite common thing. So there's been a lot of pushback. The Mortgage Bankers Association has been really lobbying and pushing in Washington to try to get that removed. Looks like they're having a lot of positive momentum. It's actually evident that they're having a lot of positive momentum. So the hope is that they're actually going to eliminate that rule.
Yeah.
And we won't
For right now, we know that it's pushed back to August 1st, but hopefully, right, like you said, momentum headed in the right direction. We could even possibly get it eliminated.
Yep.
Stay tuned for more updates on it.